Okay, now let's practice on some accounting questions. And these questions are vary from different topics, including debit and credit, accounting equation, statement of profit or loss, statement of financial position, and others. Let's have a look. So the first question we have a look here, it's the question number 1, and these are theory questions. And the first question, what are the main 3 financial statements? So we have 3 main financial statements. We have the first one is statement of profit and loss. We have also statement of change in equity, and we have a statement of financial position, statement of financial position. Okay, these are the 3 statements available. Of course, we have also another statement of cash flow, but these are the 3 main financial statements. Statement of profit and loss, which measures the profitability of a business, statement of change in equity, and statement of financial position. Okay. Second question. Second question, which statement shows summary of a company's financial position at a specific date? So when we talk about financial position, we talk about what? Statement of financial position. Statement of financial position, it's the one, is the statement which relied on the accounting equation. So this is a statement of financial position which has the assets, liabilities, and equity. So that's a statement of financial position. Okay. Excellent. Right. Question number 3. What is the basic accounting equation? So accounting equation have 2 versions, assets minus liabilities equal equity, or another version which is assets equal liabilities plus equity. So it depends on the question itself. Yeah, it depends on the question itself. You can use which version really. So assets minus liabilities equal equity, or assets equal liabilities plus equity. Okay, sounds perfect. Nice. Question number 4. Which statement summarizes the profitability of an organization for a particular period? And this is statement of profit or loss, or we call it income statement. Yeah, statement of profit or loss, or we call it the income statement. Income statement that measures the profitability of any business, measures the profitability. That's sales revenue minus cost of sales equal gross profit. Gross profit minus expenses equal operating profit. And then you add other income. You take away the tax and interest payable, and you will leave the net profit or profit for the year. So that's a statement of profit or loss. So question number 5. Okay. If the total liabilities of a business decreases by 100,000 pounds, so what will be the effect of total assets, assuming the amount of equity remains the same? So if the total equity remains the same, okay, and the total liabilities decreases by 100,000 pounds, so that automatically the total assets will also decrease by another 100,000 pounds. So that's automatically, yeah. Again, if the total liabilities of a business decreases by £100,000. So what will be the effective total assets? So the total equity is the same. It doesn't change, right? I'll give you an example, right? If you want to apply the accounting equation, which is assets equal liabilities plus equity. So what happened? The question tells you, let's assume that assets, it's what? It's £500,000. Okay, let's assume assets, it's £500,000. Okay, equal liabilities, let's assume liabilities is what? Is £400,000, and equity is what? Is £100,000. Right. So here we go. Just we making up some numbers, right? So assets equal liabilities plus equity. So assets £500,000, liabilities £400,000, equity is £400,000. So we're just only making up some numbers, yeah? So the question tells you, right, equity doesn't change. Equity doesn't change. It stays £100,000. It's the same, yeah? So equity doesn't change. It stays £100,000. However, what tells you the question? If the liabilities, this liability decreases by £100,000. If the liabilities was decreases by £100,000. So instead of £400,000 became what? £300,000. In this case, assets must decrease by how much? By another £100,000, because it needs to be 400 instead of what? Instead of £500,000. So the answer is decrease by £100,000. Right. Okay, that's number 6. Now let's move to number 6. Okay, number 6. What will be the effect on equity if the business owners withdraw cash for his or her personal use? Right. So we now are talking about something called drawings or withdrawals. And if there is drawings or withdrawals, means that when the owner takes the money for his or her personal use, for example, she fancy Lamborghini, she withdraw £200,000, right? So in this case, the equity will be impacted negatively. The equity will be decreased. The equity will be decreased. So the answer is equity will decrease. Decrease in equity. Decrease in equity. Okay. The answer is decrease in equity. Decrease in equity. Okay. That's great. Okay. Number 7. Right. What's number 7? Right. Number 7. Which statement is the practical implementation of the accounting equation? I mean, I've just mentioned about the accounting equation, and the accounting equation is basically related with a statement of financial position or the balance sheet. Statement of financial position. Balance sheet. Okay, balance sheet. So the balance sheet is the statement of financial position, and this statement is basically the accounting equation, based on the accounting equation, which is assets minus liabilities equal equity, or assets equal liabilities A plus equity. Okay, sounds perfect. Let's move now to question number 8. Yeah, question number 8. Question number 8 asks you to list 3 external and 3 internal users of financial information. Now, when it comes to financial information, there are users can be classified as internal users and can be classified also as external users. So these are people are interested in the financial data of such a company. Okay, let's have a look. For example, if you talk about external users, let's get some examples of external users. So let me see, for external users, like let's say, for example, government, yeah, suppliers, yeah. Think, guys. Do you want to say something? Come on. Suppliers, banks, maybe. I mean, lenders. By bank, lenders, government, suppliers, banks, maybe customers, maybe potential investors. Yeah, so there's a lot of external users, right? So these are external users. In terms of internal users, okay, in terms of internal users, we have examples, if you want, employees, managers, what else? Employees, managers, what else? Maybe directors. So these are what? These are all internal for the organization. These all internal for the organization. Okay, hope it's clear. So that's done, and that is done. That's done. That's done. That is done. That is done. And this one is done. So that's question number 1, 2, 3, 7, 6, 7, 8. 8 done. So far. Now let's move to 9, isn't it? Yeah, 9. Here we go. Right. Let's move to question number 9. Which one can be considered as the most important phase of accounting cycle? And it is the primary objective of the financial accounting. So when you talk about the accounting cycle, of course, the most important cycle or the most important phase of accounting cycle is, of course, preparing the financial statements. So that's preparing the financial statements. Okay, preparing the financial statements. Okay, good. So if you remember the cycle, the phases, the first one, identifying the economic event, then you record the transaction, and after that in the T account, if you remember, and one of the most important phases in the accounting cycle is preparing the financial statements. Okay, dokie. That's number 9, yeah? Okay, dokie. So let's move to question number 10 now. And question number 10 ask you, what are the 5 elements of financial statements? We have 5 elements of financial statements, and that include assets, liabilities, equity, revenue, expenses. Okay, these are the 5 elements of financial statements. The 5 elements of financial statements: assets, liabilities, equity, revenue, and expenses. Question number 11. Give me an example of a current assets. Now, when it comes to the accounting equation, we have assets, liabilities, and equity. And assets is divided into non-current assets or fixed assets and current assets. And liabilities is divided into current liabilities and non-current liabilities. So assets is all what the business owns, is all about what the business owns or control. An example of current assets can be such as we have cash and bank, we have closing inventory, we have trade receivables. Okay, so all of that, guys, we have as examples of current assets. Of what? Of current assets. all the business own or control for a short period of time for less than a year. Okay. Of course, fixed assets or non-current assets is assets for the business for more than 1 year, and these assets are used for the business. These assets for the business use. I'm talking about the non-current assets, non-current assets, such as equipment, fixtures and fittings, buildings, trucks, buildings, stuff like this. Premises. Okay. Now, in terms of current liabilities, okay, in terms of current liabilities, so again, liabilities is divided into current liabilities, these obligations on the business for less than 12 months, and non-current liabilities, it's obligation on the business for more than 12 months or 1 year. Examples of current liabilities. Give me some examples. If you think about, let me think, bank overdraft. Okay, bank overdraft, trade payable, can be dividend payable if the business is listed and wants to pay dividends to the shareholders. It can be under current liability. Also, tax payable. Tax if the company needs to pay tax, and also is the liabilities, obligation of the business to pay tax to the tax authorities in the UK. It's called HMRC. Okay, here we go. That's examples of current liabilities. Examples of non-current liability is a typical example of non-current liability is a bank loan, because loans usually takes more than 1 year. Okay, right. Here we go. Perfect. Excellent. Lovely. So let's move to question number 13. And question number 13 asks you, what is net working capital or net current assets? Again, net working capital or net current assets. It's total current assets minus total current liabilities. Okay, total current assets minus total current liabilities. That give you what? That gives you the net working capital. Okay. Right, guys? Okay. Let me see. Here we go. Excellent. That net working capital or net current assets equal total current assets minus total current liabilities. Nice. Okay, right. Number 14, right? So identify the correct sequence of accounting process. So the correct sequence of accounting process, the first thing we need to do is what? Identifying the transaction. Then after that, we record the transaction. And after we record the transaction, we communicate. So that's identifying, recording, communicating. So when it comes to identifying transaction, so recording it on T account, and after that communicating means prepare the financial statements. Okay, perfect. Nice. Okay, that's all. That's question. Let me put it in bold. And this one also. This one. Okay. This one, number 11. Okay, and number 13 and number 14. And last question here. This is the last question now. Is all now here done. Let me check. Is all done, guys. The last question, and question number 1 is, what is the first phase of accounting cycle? And I just mentioned this one. If you remember, the first phase is identifying. identifying. But if you want to really keep it in a bit details, it's identifying the economic event, an economic event or transaction. Okay. Okay, excellent. That's it. So as I mentioned, because we did mention the sequence of accounting equation or accounting process in terms of identifying, recording, communicating. If you want to be specific, guys, so identifying is identifying an economic event or what, or transaction, or what, or transaction. Okay, guys, make sense? Okay, dokie. Here we go. So that's all question number 1. That's to do with what? With a question number 1. Okay, that's fine. Okay, dokie. Yeah. So now let's move to a question number 2, and we have various question of question number 2. Right, let's move to question number 2. Okay, dokie. Question number 1 here. An asset with the first cost of £10,000 or £100,000, okay, is depreciated over 5-year period, and it is expected to have a £10,000 disposal value at the end of year 5. Using the straight line method, what is the net book value at the end of year 2? Okay, now this topic talks about depreciation. Depreciation is a very important topic in accounting. And what is the purpose of depreciation? It's to depreciate the fixed assets. The business, they have fixed assets such as equipment, cars. When the businesses bought these fixed assets, they bought them at the full market value. So of course, these fixed assets are reducing value every year. So, and the company need to reflect the current value, the fair value of these assets in the statement of financial position. So it's wrong for the business to record these fixed assets at the same price or the same cost they bought when they bought it. So that's why we have to depreciate these fixed assets. We have 2 types of depreciation, 2 methods. We have straight line methods, and we have reducing balance method. So when you look at depreciation in question, you always need to look at 3 things. First, what is the cost, which is £100,000 here? Second, what is the disposal value, which is £10,000, as you see. Disposal value, or we call it residual value, means that how much the business expect to sell the assets after the useful life, which is 5 years. If you look, number 3 is the useful life, which is 5 years. These are the estimation. The business estimates that after 5 years, they will sell the assets for £10,000 as disposal value. Here we go. So using the straight line method, we need to calculate the net book value at the end of year 2. Net book value means we need to calculate the fair value for the assets at the end of year 2. The first thing you need to calculate depreciation. Okay. All right, let's have a look and calculate depreciation. Depreciation equal the formula to calculate depreciation based on straight line method is cost minus residual value or disposal value is the same, yeah? And then you divide by useful life. Okay? You divide it by useful life. So again, cost, what is the cost? It's 100,000. If you apply it, don't forget the bracket. Minus, we have residual value, which is 10,000. and you take you divide it by useful life, which is 5 years. You divide by useful life, which is 5 years. So if you calculate it, okay, that makes, okay, 90,000 divided by 5 years equal 18,000 pounds. So that makes 18,000 pounds, and that is the depreciation. And that is the depreciation, 18,000 pounds. Okay, great. So that's the depreciation, 18,000 pounds here. So now the question asks you to calculate the net book value at the end of year 2, right? So the depreciation charge, 18,000 pounds, under the straight line method is fixed every year for 5 years. Means like every year for 5 years, we're gonna charge depreciation 18,000 pounds under statement of profit and loss under the expenses. Now, what is the net book value? What is the formula for net book value? The formula for net book value equal cost minus accumulated depreciation. Cost minus accumulated depreciation. So cost is the cost, which is 100,000 pounds. We have no issues with the cost. Minus accumulated depreciation. What do I mean by accumulated depreciation? Accumulated depreciation is the depreciation for this year and also previous years. Again, the accumulated depreciation is the depreciation for this year and also the previous years. So for this year, every year is 18,000 pounds. So for year 2 is 18,000 pounds, and for year 1 is 18,000 pounds. So that's equal 36,000 pounds, the accumulated depreciation for year 1 and year 2. So in this case, how much we will have? 64,000 pounds, which is the net book value at the end of year 2, the net book value at the end of year 2. Okay, and that is what this is, the fair value, the current value of the assets at the end of year 2. Okay, so if I ask you in the question, for instance, instead of 2, right, instead of year 2, if I put year 3, so what you need to do? In this case, you need to calculate depreciation for 3 years. So 36 plus 18 equal what? Equal 44,000. Oh, sorry, that's 36, 46, 56, that's 54,000. 54,000 will be the total accumulated depreciation. 100 minus 54, that would be what? Would be 46,000. 46,000 pounds, and that is the current value or the fair value at the end of year 3. So be careful when you look at the question and look at the requirement. So the answers for this, it's 64,000 pounds. Okay, that's great. Let's have a look at question number 2. On January 17, the Toy Corporation purchased a machine at a cost of 55,000 pounds. So the cost is 55,000 pounds. The machine expected to have a useful life of 10 years. That's fine. And no residual value. No residual value. It means residual value is 0. And the straight line depreciation method was used. Okay, in this case, that's in 2017. So if you want to calculate depreciation in this case, if you want to calculate depreciation charge, okay, in 2017, if you want to calculate depreciation charge, you just need to apply the same formula, which is, if you remember the formula, it's the cost minus residual value divided by useful life. So the cost is £55,000 minus 0, because residual value equals 0. Don't forget this. Divided by useful life, which is what? 10 years. In this case, the depreciation is what? Is £5,500. £5,500. That is the total depreciation. That's the depreciation charge for 2017. So that's absolutely fine. That's understandable, easy. But now, what happened here? In 2019, the estimated or the estimated residual value was revised from 0 to £6,000. So you need to calculate the depreciation for 2019 now. Okay, so now depreciation charge in 2017 is £5,500. In 2018, same, it's 5,500. But now what happened in 2019, guys? In 2019, what happened? In 2019, we revised the residual value. Instead of 0, now it's £6,000. And since we revised the residual value from 0 to £6,000, so we need to calculate a new depreciation. Yeah, we need to calculate what? A new depreciation. So we know in 2017, 5,500. We know in 2018, 5,500. That's fine. It's clear. But now in 2019, what we need to do, guys, we need to calculate a new depreciation. A new what? A new depreciation, right? But before we calculate the new depreciation, we need to find out the new cost. We need to find out the net book value for this asset. Because it's being revised, we need to find the new net book value for it. And first, if you remember, the net book value, it's what is the cost, which is the £55,000 minus the residual value. So the residual, minus the accumulated depreciation. The accumulated depreciation for 2017 and 18. So you have, actually, that's not really in 2019, really. I would say net book value for 2018, to be honest with you, right? Okay. So 55,000 minus what? Minus 5,500. 5,500, that makes 11,000. So, right, so here we go. So 55 minus 11, that makes how much, guys? That makes £44,000. So that is the net book value. This is the new net book value which we need to use. That is the new net book value which we need to use, because in 2019, so it's being revised, some data has been changed, and we need to find a new figure. So now, what happened in 2019, really, you just need to just apply as you know. So 2019 depreciation, just follow the equation, the typical equation of the depreciation, which is the cost. So now the cost is £44,000. Now we need to have this figure minus residual value, which is the new residual value is £6,000, divided by useful life. Now the question is, the useful life is 10 years or 8 years? It's 8 years. Why 8 years, guys? Because there are 2 years gone from 17, 18. So what's left is 8 years. So 44 minus 6, that makes 38,000. Divided by 8, it's 4,750. 7,450. Okay, let me make sure. Yeah, £4,750. And that is that depreciation for what? For 2019. This is the depreciation for 2019. Okay, so the trick here, you just need to figure out the new net book value in 2018 in order to calculate a new depreciation in 2019. Okay, that's question number 2. Now, let's move to question number 3 now. Question number 3. At 30th of September, fixed assets 76,000, Inventories 8,200, trade payable 5,300, loan 10,000, it's long term, and bank overdraft 2,180. And the question asks you to calculate the capital as at 30th of September. So this question based on the accounting equation. As long as you know the accounting equation, how it works, you should be able to know this question easily and calculate the capital. So capital is the same as equity, yeah? So you need to know under each category what comes under assets, what comes under liabilities in order to calculate this question. So if we figure out, okay, let me figure out. So here we go. Assets minus liabilities equal equity. Assets minus liabilities equal equity. So that's the accounting equation. So what comes under assets? So we have fixed assets, which is 76,000. And also we have inventories. Inventories comes under current assets, yeah? 8,200. So that would be the total assets. So 76,000 plus 8,200. Of course, that make 84,200. Right? Okay, great. Done. Liabilities. So in liabilities, we have a trade payable. Trade payable, that's in particular, that comes under current liabilities. We also have the bank loan. That comes under usually, in particular, the non-current liabilities, 10,000. Also, we have the bank overdraft, and that comes particularly under current liabilities. So if you add up all the current liability, including 5,300 plus 10,000 plus 2,180, that makes 17,480. And that's the total liabilities. So in this case, once you know the total assets, total liability, then you just apply the equation, isn't it? Simple like that. So capital or equity equal what? Assets minus liabilities. So yeah, which is 84,200, 66,700, 66,720. So that's the answer. That is the answer. Right, guys? So that's the answer. I hope it's clear. It's really simple, straightforward. It just the way the trick is, just you need to figure out what comes under assets, what comes under liabilities, and what comes under under equity. And that is really the point of this question number 3. Okay, question number 4. Question number 4. Okay, let me see. Okay, it's fine. Here we go. Right. So here that Isa had a net profit of £60,000. So that's a £60,000 net profit. That's fine. Okay, dokie. Current assets 234,500. For assets, total assets 700,500. It's fine. But what happened? He has since discovered that the inventory figure he used is understated. Right. Was understated, as he left out closing inventory valued £20,100. Okay, right. So what would the revised net profit be for the year? What would be the revised net profit? So, guys, a simple way to understand. So basically, first of all, remember that 400, we don't need it. Total assets, total current assets, total assets, we don't need it. These are tricks, yeah, for you. Just please ignore them. So they are not really related to any question, are not relevant really. So what really happened when you calculate the profit? If you missed out that closing inventory, when you calculate cost of sales, if you remember the formula, it's sales minus cost of sales equal profit, yeah, or gross profit. So if you missed out the closing inventory, the impact on the profit will be less. And as a result, in order to revise the net profit, what you need to do, you just need to add up the value of a closing inventory on the profit, on the net profit, the £60,000. So the answer should be logically to say £60,000 plus the closing inventory, the £20,100, which is the one understated, the one we lifted out, the £20,100. So that's equal 80,100, and that is the answer, 80,100 pounds. So again, so the answer should be 60,000 plus 20,100. That makes 80,100 pounds. So why? Because we understated closing inventory. We need to add it back on the profit. So now, if you are not sure about it, so let's prove it. Let's prove it. Okay, let's do it. I'm gonna make up some numbers, yeah? Let's assume sales equal £10,000. Okay. Minus cost of sales. Cost of sales, if you remember the formula, opening inventory. Okay, maybe that. Minus cost of sales. We have opening inventory. Let's assume the opening inventory. How much, guys? How much you want? 4,000? 4,000. Fine. Plus purchases. Okay. Let's assume the purchases is 1,000. That's fine. Minus a closing inventory. Okay. And let's assume how much a closing inventory. Let's say, I don't know, a couple of thousand. Yeah. 2,000. Here we go. I'm just trying to approve it. To approve it. So the cost of sales, 4,000 plus 1,000 equal 5,000 minus 2,000 equal 3,000. So the cost of sales equal 3,000. So in this case, the profit would equal what? £7,000, correct? £7,000. Why £7,000? Because sales 10,000 minus 3,000, which is cost of sales, that makes 7,000 profit. So that's a normal one. This is a typical way of how to calculate the profit. That's fine. There's no issues about it at all. Now, what the question tells you really, that you missed out the closing inventory. You missed it out. You didn't bought 2,000. You missed it out. You bought, instead of 2,000, you bought 0. You bought what? You bought 0. And as a result, what happened with the closing inventory or cost of sales would be 4 plus 1, 5,000 minus 0 equal 5,000, isn't it? Equal what? Equal 5,000. Can you see? And as a result, what happened with the profit? It's now 5,000. So basically, it's less than 2,000. It's less than 2,000. From 7,000 to what? Now it's 5,000. So can you see, guys? Because we missed out because we missed out, we understated the closing inventory or missed it out by 2,000. So automatically, what happened with the profit? It reduces by a couple of thousand. So in order to revise the net profit, what we need to do, we need to get back and put 2,000 here. This is how much we missed. And cost of sales will be, instead of 5, will be 7,000. And as a result, the most important thing, the revised net profit will be increased by what? By 2,000. That would be 7,000. It will be 3. No, sorry, I made mistake. Yeah. So that's a 3,000. Okay, dokie. And that is blah, blah, blah. That's 7,000. Here we go. So we increase 2,000 here. And that's a proper cost of sales, which is 4 plus 1, 5 minus 2 equal 3. Here we go. So the question is, the point here, that if you miss the closing inventory or it was understated, what you need to do in the net profit or the revised net profit, you need to add it back. You need to what? To add it back on the net profit. So be careful. You might have in the question, instead of understated, you might have overstated. And if you have overstated, this means what? You need to put vice versa. So you need to take it away from the revised profit. Deduct the revised profit by the amount of overstated. Not add it back, you just take it away. Okay, so it depends. But as long as you understand how it works when it comes to understated, you should be able to know it right. Okay, and that's question number 4. That's question number 4. Okay. Okay, that's question number 4. Right, here we go. List man, here we go. Question number 5 now. Alex buys 100 pairs of shoes for £30 each. So that's 100. Here we go. By £30 each. He sells 20 of these, 20 out of 100 at £50 each. This is the selling price. And the expenses, the total expenses is £150. And the question asks you, what is the operating profit? So in order to do that, we need is a typical statement of profit or loss or the income statement. You need to calculate the cost of sales and the gross profit in order to do that. Okay. So let's do it. Sales. So what is the amount of sales? Sales equal £3,000. Why? Because actually not 3,000, it's 1,000, isn't it? Because we have a 20. He sold a 20 at £50 each. Yeah, that's 1,000. That makes 1,000. Yeah, that makes 1,000. Okay, that's fine. So less cost of sales. And if you remember the equation, opening inventory plus purchases minus a closing inventory. Here we go. Right, here we go. Let's do it, guys. So what is the opening inventory? The opening inventory is 0. We do have no opening inventory in the question. The amount of purchases is what? Do you want to call it? 3 grand, £3,000. Why £3,000? Because look here, we bought 100 at 30 each. So the 100 times 30, that makes £3,000. And the closing inventory, that's the tricky one. So I don't know if you guess, but can you see we have 100 here, and from 100 we sold only 20. In this case, how much left in the inventory, the closing inventory? 80. So this 80, what is the value of this 80? You just multiply each by 30, so that makes £2,400. Okay, So 0 plus 3 equal 3 minus 2, 400. That makes 600 pounds. So the cost of sales equal 600 pounds. The cost of sales equal 600 pounds. So the gross profit equal the sales 1,000 minus the gross profit, sales 1,000 minus cost of sales equals 600. So that makes a gross profit of 400. So the gross profit 400. But now the question doesn't ask you for the gross profit. The question asks you for operating profit. Operating profit means after expenses. So what you need to do, you need to take away the expenses. So here we go, less expenses. How much the amount of expenses available here in the question? It is, how much we have? 150 pounds. Okie dokie. Here we go. And that way you will have the operating profit of 250 pounds. 200 and what? And 50 pounds. And that is what? That is the answer. The answer is 250 pounds. It's 250 pounds. So be careful when it comes, you need to understand the difference between gross profit, operating profit, or the net profit. Because it depends on the question what they ask you. They might ask you to calculate the gross profit. The question might ask you to calculate operating profit, or the question might ask you to calculate the net profit. So really, really depends. Okay. Fine. Okay, dokie. Here we go. Perfect. So now let's move to question number 6. Question number 6. Right. Question number 6 is a bit similar to the one we calculated in 5, but here they ask you to calculate the cost of sales, gross profit, operating profit, and what? And the net profit. And what? And the net profit. So here we go. So the business made sales 45,000 pounds, purchases 25,000 pounds. The inventory at the beginning of the year, that's a opening inventory. That's opening. So be careful, guys. That's opening. And at 31st of December, 4,500. This is the closing inventory because end of the year. Expenses equal 1,500. And the tax equal 1,000 pounds. And the tax equal what? 1,000 pounds. Okay. So if you look here, so there's a lot of things you need to do, but let's figure out and calculate cost of sales first. Okay, let's how to do it. Sales. Right now, you need to be quicker with me. So sales, how much sales is already in the question? 45,000 pounds. Nice. Less cost of sales. So again, you should be able to know the formula for cost of sales. Opening inventory plus purchases minus what? Minus closing inventory. Yeah. Okay. Here we go. That's great. Excellent. Nice. So here we go. This cost of sales. So what is the opening inventory? If you look here, the opening inventory, it is what? It is 8,000. Purchases, as you see, purchases here, it's 25,000. I'm just plugging in numbers from the questions. And we have a closing inventory. It's how much closing inventory? It's 4,500. 4,500. Here we go. Perfect. Here we go. Apply the cost of sales. That makes 8,000, which is opening inventory, plus purchases, 25,000, minus closing inventory, which is 4,500. That makes it 28,500. 528,500, and that we call it cost of sales. Cost of sales. Remember this. That's really, really important to remember. What does that mean? Cost of sales based on this equation. So now the gross profit after the gross profit equal what? Gross profit equal the sales minus cost of sale. The sales minus cost of sales. So the sales equal £45,000 and the gross profit, the cost of sales equal 28,500. So take away the £45,000, that makes £16,500. 16,500, and that is the gross profit. So after the gross profit you calculated, we need to less expenses in order to find out the, what we call it, the operating profit. If you look at the question, what is the expenses equal? Expenses equal 1,500. So equal 1,500 minus, that gives you what? Gives you operating profit. Operating profit, and operating profit, that makes 16,500 minus 1,500, that makes £15,000. £15,000, that's operating profit. And the last one, and the last one here, what you need to do, the last one here, what is it? You need to take away the tax. What's left really? Tax. You need to take it away in order to achieve the net profit. In order to achieve what? The net profit. So that minus tax. Okay, here we go. So that makes a net profit of what? Of £14,000. £14,000. So that's 2,500, 16, £14,000. Here we go, guys. So that is the key here. The key is just, you need to understand, it depends on the question. The question might ask you to calculate what is cost of sales. You should be able to know what's cost of sales. The question might ask you calculate the gross profit. You need to know how to calculate the gross profit. The question might ask you to calculate the operating profit. You need to know how to calculate the operating profit. And the question might ask you to calculate the net profit. And you should be able to know how to calculate the net profit. So this is really, really important. This is really important to know what you're doing, and you know what you're calculating exactly. Yeah. So it's really, really important. So be careful when you read the question. Be careful. Look at the requirement in detail. Look at the requirement carefully. Always understanding the question is 50% of the solution. Okay. So that is question number 6, isn't it? Yeah. Okay. Okay. Here we go. Excellent. Right. Nice, nice, nice. Okay, dokie. Here we go. Let's have a look at question number 7 here. So 500,000 at £1 ordinary shares. When you see this 500,000, this is the number of shares and not the £500,000. So that's really important. 500,000 shares at £1 ordinary shares mean this is a nominal value. This is what? This is a nominal value. So ordinary dividends paid 10 pence per share. And the question asks you to calculate what would the dividend paid be. What would the dividend paid be? So it's very simple. Just you need to find out what is the number of shares, which is 500,000 shares. Okay. You just multiply it by the dividend per share, which is 10 pence. 10 pence mean 0.10. 0.10. So make sure that you don't get confused. It's 5 pence, 0.05. 10 pence is 0.10. So for example, here, if you calculate this, you should be able to find the answer, which is £50,000. So that's the answers. That's a clear, nice. if the question asks you 5 pence, 5 pence means 0.05. 0.05 means 5%. So don't get confused with this, please. Okay? Okay. So now let's trick the question. Instead, what I'm going to do here, I'm going to change this to 500,000. Okay? 500,000. And I want to write here 0.5. Okay? 0.50. Right. So that's a nominal value. So if I change this, so what would happen here? So the 500,000 pound, this is a 500,000 pound. Okay? 500,000 pound at 50 pence ordinary shares. Okay? That means this is the not number of shares. And the nominal value, this means the value for each share is what? Is 50 pence. The nominal value of each share is 50 pence. So before you calculate it, what you need to do, you need to find out the number of shares. So how to find out the number of shares is based on what? Based on the nominal value. So you divide the 500,000, where's my calculator? So the 500,000 pound, 500,000 pound, you divide it by 50 pence, you can find out the number of shares. So the number of shares equal 1 million shares. 1 million shares. And then after you find out the number of shares, then you multiply it by y, by 10 pence. That will be the answer, 100,000 pound. So be careful. This is a trick, yeah? You just need to figure out what's going on here. So this is what you need to do. If you see pound here, this is the value of the shares. These are the value, not the number of shares, because a pound, and this is a nominal value for each share. So in order to find out the number of shares, you need to divide the value, which is 500,000 pound, divided by 50 pence. That will give you 1 million shares. And after that, you multiply it by what? By 10 pence to find the total dividends. So this is a trick, just figure out. Come back to this. So this is that original question. And from the original questions, we have 500,000 shares times 10 pence, which is dividend per share. That makes 50,000 pound. That's fine. So let's move to question number 8. Question number 8 is an interesting question. So this is trial balance. So as you see, there are various accounts here. There is opening capital. There is sales amount, the credit side. We have purchases. We've rent, motor vehicle, drawings, general expenses, and bank on the credit side. And the total is 135, as you see. So if you look at this question here, you can see that the closing inventory equal 8,000. And the depreciation to be ignored. There's no depreciation in the question. And the question asks you to calculate the operating profit, So remember in question number 8 here that there are some accounts which are not relevant, such as opening capital. Opening capital is not relevant. Motor vehicle is not relevant. It's a fixed assets. It's not relevant to expenses, income. Drawing is not relevant. It's in the equity. And bank is not relevant also, because bank in a statement of financial position. So of course, if you can see bank here, it comes under credit side, means is a current liabilities, means bank overdraft, because bank, it can be debit, can be credit. Credit, if it's a credit, means bank overdraft, means a current liability. But if bank listed on the debit side, means is a current assets, Remember the debit and credit rules. Money in, debit, money out, credit. So let's figure out how to calculate the operating profit. So the same, I think at this point, you should be able to know how to calculate that straight away, the sales and cost of sales. Sales quickly, let's do it together. Sales equal £105,000 minus cost of sales. Cost of sales, opening inventory plus purchases minus closing inventory. I hope at this point you memorize the formula. Okay. So opening inventory is 0. There is no opening inventory. Purchases in the question, £64,000. Can you see it in the question? And the closing inventory is what? Is £8,000. Here we go. So the cost of sales makes how much? 64,000. If you take away the 8,000, that makes 56,000. That's cost of sales. Okay. So the gross profit equal what? The 105,000, which is 105,000 minus 56, that make 49,000. 49,000, and that is what? That is a gross profit. But the question asks you to calculate the operating profit. So since the question asks you to calculate the operating profit, this means you need to take away the expenses, which is how much the expenses here. Right, here we go. We need to figure out what the expenses here. How much expenses we have, guys, here? So we have rent, 6,000, and we have general expenses, 27,000. So again, we have rent, 6,000, and we have a 27,000. That's 33,000 pounds. So that's minus expenses. Okay. Minus expenses. That's 33,000. Okay. So here we go. Let's make operating profit. Of what? 49 minus 33. That makes what? Makes 16,000, isn't it? Is that 16,000, I think? Okay, 16,000 pounds. And that is what? That is the operating profit. That is the operating profit as the question mentioned here. So they ask you to calculate the operating profit, which is the 16,000 pounds. 16,000 pounds. Here we go. That's all the answers. I hope it's clear. And don't get confused by we call it the other accounts in the question. You don't need to use them. Yeah, you don't need to use them. Yeah, that's great. So that's question number 8, isn't it? That's question number 8. Now let's move to question number 9. Question number 9. Yeah. Question number 9, a statement of financial position shows ordinary share capital of 300,000 pounds. So that's a 300 pounds. 300,000 pounds is the share capital, ordinary share capital. Yeah, ordinary share capital. Okay. And the share premium of 100,000 pounds. So the share premium is what? Is 100,000 pounds. That's a share premium. At the beginning of financial year. So here we go. At the beginning of financial year, you need to be careful here. You need to be careful at the beginning. So at the beginning, what happened? Let's do it. Share capital equal 300,000 and share premium equal 100,000. Okay, fine. There's no issue. If the ordinary share capital, what it tells you, if the ordinary share capital is 500,000 pounds and share premium is 240 at the end of financial year, how much did the ordinary share issue raise, including share capital and share premium? So what happened? This is the beginning of the year. This is the beginning of the year, right? At the end of the year, the share capital at the end of the year becomes 500,000. Okay. And the share premium at the end of the year became 240. Can you see? 240 and 500. So that's the end of the year, right? The end of the year. So the question is now, okay, the question is now, how much did the ordinary share issue raise, including the share capital and share premium? So in share capital, if you see the difference, how much is the difference? So 500, it was 300 at the beginning of the year, and the end of the year, 500. So increased by how much? 200,000. Oops, what's that? Okay. And share premium for how much? So it was 240. I mean, it was 100 and now 240. So there is increase of what? Of 140,000 pounds. So basically, if you add them up together, so the increase would be 340,000 pounds. And this is the answer. The answer is what? 3,400 and 1,000. That is the answer. So the answer, 340,000 pounds. 340,000. And that's the difference between the beginning of the year and what? At the end of the year. At the end of the year. Okay. So that's question number 9. Question number 9. Okay. So now let's move to question number 10. Question number 10. If cash is 1,000, so cash is 1,000, stocks 4,000, trade receivables 5,000, equity and liabilities 15,000 together. So what is the amount of total fixed assets or non-current assets? So again, so this is a question based mainly on the accounting equation, So in order to calculate this question, so if you use the accounting equation, which is assets equal liabilities plus equity, isn't it? Assets, liabilities plus equity. Right, here we go. And assets, liabilities plus equity equal 15,000 pounds. Equal what? Equal 15,000 pounds. 15,000 pounds. The question asks you, right? So this assets must equal 15,000 pounds. Must equal. There's no choice, yeah? There is no choice because must equal 15,000 pounds. So all the assets comes under, what comes under assets? We have cash. So cash comes under current assets. So here we go. Let's have a look. So we have, what's that? Right. We have current assets. Current assets We have £1,000 cash. We have a stock £4,000. We have trade receivables £5,000. Okay, if you add them all together, that makes what? £10,000. So the total current assets, what is £10,000? The total current assets is £10,000. And we know that assets equal what? Assets, it does include the current assets and also what? Also the fixed assets or the non-current assets. If the current assets makes £10,000, that means the remaining will be the fixed assets or non-current assets, and this makes what? How much? To continue and make it £15,000, that makes £5,000. So the total fixed assets, so total fixed assets equal 15,000 minus 10,000 equal £5,000. Equal £5,000. The total fixed assets is equal £5,000. So because that makes £5,000 total fixed assets and also makes the total current assets is £10,000. So if you add them up together, that makes £15,000. That makes £15,000, and that's equal equity. But the answer is £5,000. Right. Okie dokie. And that's question number 10. Question number 11. I mean, if you look at this equation, sounds easy question, straightforward, but it's not really. I mean, this question is really tricky, and you'll be surprised that a lot of people, they get mistaken with it. So find out the value of assets if liabilities, actually not this question, actually no, not this question, no. I meant the question number 12, sorry, I meant mistake, sorry. It's my mistake. I meant the question number 12. Question number 11 is really straightforward, really. Is nothing really. Assets equal liabilities plus equity. So, okay, that's straightforward, really. Assets equal liabilities. Assets, which is liabilities, are 5,000. Equity is 6,000. So I imagine it's 6,000, isn't it? So 6,000. So the assets equal £6,000. £6,000. Yeah. So that's really straightforward. The question really is not difficult one. It's really straightforward question. But now let's come to the question. It's really confusing, and this is a question. So I mean, a lot they make mistake with it. So yeah, let's have a look at this question and try to find out what is going on in this equation. Here we go. Right. Matthew had net assets of £38,000. Here we go. £38,000. What is the net assets? So be careful. Net assets. At 31st of December. So this means end of the financial year. During the year to 31st of December, this means from 1st of January 2019, from 1st of January 2019 to 31st of December 2019. So what happened really during this financial year? He introduced £19,600 additional capital. So this is capital, yeah? Additional capital into the business. Profit 16,000. Withdrawing or drawing 8,400. What was the balance of Matthew's capital at the beginning of the financial year? Right, that's interesting. So at the beginning, the capital at the beginning of the financial year. So I know it's a bit tricky, it's a bit confusing, understand, but let's try and work it out together in very simple way. In very simple way. If you know basic math, I think you should be able to do it right, to be honest with you. Right. Okay. What is, okay, let's figure out. So the capital or equity at the end of year equal. Right. We have here, what we have here? We have here the beginning, the capital at the beginning of the year. So that's capital, which is, this is the, what we call it, the requirement, capital at the beginning of the year. Okay. Plus we have additional capital plus profit, and this minus drawing. Is that right? Yeah, profit drawings. Okay, that's the formula. Very simple. Capital at the end of the year equal capital at the beginning of the year. You add up the additional capital, which is available here. You add up the profit, and you take away the drawings or withdrawals. Okay, fine. Okay, let's now apply it. So what is the capital at the end of the year? Now, if you look at the question and you say, okay, what is the capital at the end of the year? There is no capital at the end of the year. Actually, the capital of the end of the year, the equity, it's equal to net assets. Net assets. So net assets equal equity, equal capital at the end of the year is the same concept, the same term. Net assets, net assets. Remember. So net assets equal what? Actually, net assets equal what? Net assets equal total assets minus total liabilities. Yeah. So let me write it down for you. Net assets equal what? Equal total assets minus what? Yeah. Net assets equal total assets minus total liabilities. And the total assets minus total liabilities, what is the equity, isn't it? Total assets minus liabilities equal equity. So equity equal net assets. Yeah. Right? At the end of the year. Right? So the net assets or the equity or the capital at the end of the year is 32,000 pounds, 38,000 pounds. So if you need to apply the formula here, this is start 38,000 pounds equal capital at the beginning of the year. This is the requirement. We didn't know really. So it's X. I'm going to write it as X. Okay. Plus profit. How much profit? 16,000 pounds. Right. Here we go. Minus the drawings, which is actually, no, actually we have additional capital. Wait, get confused now. We have additional capital 19,600 first of all, because capital at beginning of the year is X plus additional capital 19,600. Okay, plus profit 16,000, and now minus the drawings 8,400. Here we go. Here we go. Here we go. That's it. Job done. So what you need to do really now, you just need to apply basic math skills in order to make it right. You just remember how to move this and how to apply this. It's really, really simple for Word, guys. It's not a big deal. So what you need to do, you might leave X here. Yeah. So 38,000 pounds. So then 19,600, you move it to the other side, become minus. That's minus 9,600. So this one, you move it to the other side, becomes from positive to negative. That again will be negative 16,000. And the drawings, if you move it to the other side from minus, becomes positive. So that's 8,400. That's basic math skills. So equal X. X becomes the same. We have not moved it. So yeah, that's it. If you do the math, you have a calculator. Let's do it. 38,000 pounds. We have minus 19,600 minus 16,000 plus 8,400. That will give you 10,800 pounds. And that is the capital at the beginning of the year. That is the equity or the capital. This is the equity or the capital at the beginning of the year. Is it a bit tricky question, really, to be honest with you? It does require a little bit trick in math, but please, just this is how it works. It's not that hard if you know what you're doing, really. It's not really hard. But the answer is 10,800 pounds. Okay, so let me write it down. So here we go. That's the question number 12. Yeah, and that's question number 12. And yeah, that's all to do with the question number 2, part 2. Okay. Okay, dokie. Now let's look at question number 3. Question number 3 asks you to debit or credit the following transactions. So let's have a look. Goods are sold for cash. Do you debit or credit sales account? So if you look at the debit and credit rules, it's always you credit the sales, okay? Just to refresh, so these are the debit and credit rules. Let me show you. So all assets goes up on debit side, okay? Assets go what's that? Down on the credit side. Okay, that's rule number 1. Yeah, that's rule number 1. Okay, all assets goes up on the debit side, such as we have anything goes up on the assets. For example, I don't know. For example, the company bought fixed assets, bought equipment, bought the delivery vehicle, truck. Yeah, it's all fixed assets and goes up on the debit side. Assets goes down on the credit side. Anything decreases the assets. Can be anything. For example, if the business bought something on cash, so the cash will go down, and that's assets. The cash is assets, and that will go down. Opposite of assets are liabilities, isn't it? Opposite of assets are liabilities. So liabilities goes down on debit side, and liabilities goes up on the what? Credit side. Here we go. So that's rule number 2. So this is opposite of assets. If you know rule number 1, you should be able to know rule number 2, which is any liabilities goes down the debit side. Anything, and any liabilities goes up on the credit side. Guys, okay. All income, sales, and capital are recorded on the credit side. So all the time, if you see income, any type of income, sales, any capital, always on the credit side. All expenses, purchases, and drawings are recorded on the debit side. Okay, so that's number 4, rule number 4. All expenses, including purchases, expenses, drawings, everything should be recorded on the debit side. And rule number 5, and the last one, any money in is debit, any money out is a credit. So this is a typical rule. Any money in comes to the business. For example, the business received money, cash from the sales. That's money in. You debit. You debit money in. Always you debit. Any money out, this means out means it's outside. So the business bought something on cash, bought the products, goods on cash. So always the money out, you credit the bank. You credit the bank. But this is related only to bank, only related to what? To bank. Okay, so these are the 5 rules. If you know them and you practice them, you should be able to be okay. I mean, the point or the thing about debit and credit is practice. As much as you practice, as much as you will be fine. Okay, right. So you debit or credit. Let's come back to transaction number 1. Goods are sold for cash. So the company sold goods or products, inventory for cash. Do you debit or credit the sales account? So look here. If you go back to rule number 3, you can see the sales. You credit the sales. You credit what? The sales. So you credit. So CR stands for credit. So you credit, yeah? You credit the sales. So what is the debit then? The debit will be cash, isn't it? The debit will be cash. Actually, let me write it down for you so you can understand everything. So debit, DR stands for debit, will be cash. So debit is up. So cash is up. Why cash is up? And if cash is up, is money in. And money in should be debit side, isn't it? Correct? And credit should be sales. Yeah. Okay, if we need to write the formula for you, just, sorry, not the formula, both of these. So you can understand what is debit and really what's a credit. So debit cash because money in, because we received cash. And if according to number 5 rule, any money in is debit. And sales is credit. And as you see, it is of course a credit. If you look at rule number 3, you can see it's a credit. Okay, good. Right. Okay, question number 2, or number 2 here. We have discounts are allowed to a customer, right? Discounts are allowed to a customer. So that's discount allowed. Do you debit or a credit discount allowed? Do you debit or a credit discount allowed? Discount allowed is type of what? It's type of expenses. Discount allowed is type of expenses. This is a discount which the business allows for the customer. For example, if you go, so buy 1, get 1 free, or if you get something 10% off, so that is discount, isn't it? And that discount allowed for customer. Usually we debit the discount allowed. We debit the discount allowed. So it is indeed, should be on the debit side, should be on the debit side. Okay. Right. Okay, that's number 2. Number 3. Inventory is purchased on account from a supplier. On account means on credit. So the business bought inventory, goods from a supplier on account, on a credit. Means on a credit or an account means the company hasn't paid the supplier yet. Hasn't paid the supplier yet. Do you debit or credit the trade payable? I mean, you need a trade payable, isn't it? You need what? You need a trade payable. Why you need trade payable? Because the business hasn't paid the supplier yet. So you need a trade payable. So for this T account, what you need to do, debit, it's what? Is purchases, because the business bought something, so purchases. And a credit is what? Is a trade payable. Credit is a trade payable. So do you debit or credit trade payable? Of course you credit it. Of course you do credit it. Yeah. So a trade payable is a liability. And here liability goes up. And if you go to the rule number 2, you can see liability goes up on the credit side. Liabilities goes up on the credit side. So you can see here. So the liabilities and liabilities goes up on the credit side. Purchases, always purchases on the debit side, isn't it? Because rule number 4 tells you all purchases are recorded on the debit side. Okay, so that's number 3. Number 4. Goods are sold on account. Okay, this is opposite. Now, goods are sold on account to a customer. So when goods are sold on a credit, when goods are sold on account, this means goods are sold on a credit. This means the company sold the product or service, but they haven't received the cash yet from the customer. They have not received the cash yet from the customer. Okay? So that's why we have something called trade receivables, isn't it? That's why we have something called trade receivables or debtors. So that usually the accounting equation that would be debit would be trade receivables, and a credit would be what? Of course, would be the sales, because goods are sold on account. So it's sales. Regardless if the sales are sold on account or on cash, sales is always there, isn't it? Sales is always a credit according to rule number 4, if you remember, or number 3. And trade receivables, it's debit side. You need to record it on the debit side. Why? Because the trade receivables is an asset. An asset goes up on what? Goes up on the debit side. Assets goes up on the debit side. And trade receivables is the current assets. And what happened here? This means the business wants to collect money from the customer. So the customer owes money to the business. And that's why we have trade receivables. Last one here. Last one here. We have a loan principal repayment. Yeah, a loan principal repayment, right? You repay the loan, right? This is really a point here. That's a trick here. Repayment. You repay the loan of £400 is made using a direct transfer from the bank. Do you debit or credit the loan account? So this is really tricky one, guys. This is really tricky one. You need to be careful. A typical loan that if the business took a loan from the bank, so a typical transaction would be that you credit the bank loan. You credit the loan. Why you credit the loan? Because loan is a liability and liability goes up. Yeah. Liability goes up on the credit side. This is a typical one. But here in this example, what happened really? We already took the loan and now we repay the loan, right? Now we repay the loan. So now we need to decrease the liability. We need to decrease the, what we call it, the loan account. Okay, we need to decrease it. So that's transfer. So the debit will be the loan, the bank loan. Yeah. And the credit would be what? Would be the bank, isn't it? Or the cash, right? Because it's being transferred from the business bank account. And a credit is money out. If you go back to rule number 5, it tells you any money out, it's on a credits. So that's why you bought the bank is money out in credit side. And the bank loan is on the debit side. Why we put it on the debit side? Because it's decreased. The bank loan decreased on the debit. Liabilities decreased on the debit side. And that's why we bought it in the debit side bank loan, because we repaid £400. And that's why. So this is a bit tricky one. But I hope just really you got it right. So as I mentioned, guys, this is the key for debit and credit is to practice. As much as you practice, as much as you are confident with debit and credit. Question number 4, we have a few multiple choice question here. So the first question is, accounting is best described as, I mean, if you look at the first, if you look at A, the collection and use of financial and non-financial data. B, collection and use only financial data. And C, collection of financial data. And D, the use of financial data. I mean, the answer is A. Usually accounting is the collection of and use of both financial and also non-financial data. So the answer is A. For A2, which of the following statements best describes a limited liability? A limited liability is a type of business which separate from its owners. So in law, it's regarded as having a separate existence from its owners. It is normally owned and managed by the same person. No, managed and owned and managed by the same person. It's the sole trader. Is normally non-profit making or an organization. Not really. It's normally owned by just one person. This is sole trader. D and B, it can be a partnership, really. It depends. So, but anyway, the answer is A. Limited liability does have a separate existence from its owners. So it is when you set up a business, when you set up a limited company, so you need to register in the company's house, and all the accounts should be available to public to access if they wish. But the good thing about limited liability that you are separate from the company. If anything goes wrong with the business, you are protected. Your money, your personal money is protected. So because it does have a separate entity. Okay, so that's a limited liability. So the answer for A2 is A, right? So this is A. This is A. Right. A3. Which of the following statement is true? Right. Okay. An external audit is required for all types of entity. Right. So first of all, you need to know what does audit mean. Okay, in accounting, auditing is a branch of accounting. So the difference between auditing and other or financial accounting, in the financial accountant who prepares the financial statements, again, who prepares the financial statements, including the three main financial statements, and calculate the financial figures, everything. So the auditor, their job to verify the financial statements, to look at the financial statements and see if they have been done according to the accounting rules, if they see any problem or any fraud or any manipulation. So that's the really name of the auditors or the external auditor. Okay, so usually not all businesses are required for external auditing. Okay, not all the businesses. Okay, so usually the listed business entity, only the listed, okay, the listed one, it does really require, right? It does really require listed. Listed means they are listed in the stock market. So these are large companies. Okay, which of the following statements is true? I mean, first, external auditor or an external audit is required for all types of entity. That's not correct. It doesn't require for limited company. It doesn't require for sole trader or partnership. Only does required for PLC. PLC mean public limited companies. The first one is wrong. Second, external auditors are responsible for preparing accounts. No, not the external auditors, but this is the accountants. The financial accountants are responsible. B is wrong. D, External auditors are appointed by entities management. Again, it's not correct. They are not appointed by entities management. And the last one, C, the external auditors are responsible for checking accounts. And that is true. So C is true, and that's their job, to check the account. They see if the account does reflect the true and fair value of the accounts and there is no fraud or manipulation. So A4, okay. Which branch of accounting is most concerned with the collection of detailed financial data for use, planning, and control? So when you talk about the planning and control, always straight away, you look at the management accounting. Management accounting is the branch which is concerned about planning and control. So financial accounting is mainly concerned about the external body, the external. So how to prepare the profit, when you access the profit, the financial statements, preparing the financial statements, all to do with financial accounting. Auditing is you just check and verify the accounts. Taxation is how to calculate the tax. But management accounting is more internally into the business, yeah? And we have the data to plan and control internally. So these data internally cannot anyone can access them really. A5, which branch of accounting is most closely associated with acquiring and deploying the short-term and long-term finance required by an entity? Now, the answer is financial management. Financial management is a new branch of accounting. It's mainly concerned about how to fund the business, how to raise capital. So that's mainly to do with financial management. So when it comes to short-term and long-term finance, I mean, there's a lot of methods how to raise capital, how to raise money for the business. There is a loan, bank loan. This is one of the things. Debt means you borrow from the bank. You took a loan from the bank. Also can be through share capital. Share capital means that you issue shares in the market, but share capital is only applied for listed companies. So you can trade it. For example, if a company like Apple wants to raise capital, they can issue shares in the market, and we can buy these shares in their value. I don't know, it depends how much the value of each share, and they can raise capital based on this, based on the share capital, based on equity. So yes, capital money can be raised through debt by bank loans, or can raise by share capital. So share capital through issuing shares on the market. So that's mainly how to finance and raise up capital. Okay, so the answers for A5 is D. It's the financial management. Okay. Now let's come back to the debit and credit again. So I'm sure you are familiar with the debit and credit, and that should be really straightforward. Which of the following is the correct terminology for the right-hand side in the handwritten ledger account? I mean, debit and credit, if you remember, left side debit, right side credit. If you remember this, I don't know. I hope you remember. But the answer is a credit. Of course, the answer is a credit. Why is it credit? Because on the debit side, the debit it's on the left, and the credit it's on the right. So, and now the question tells you the right. So that is the credit side. Okay. So the next question, in a handwritten accounting system, where would you record a decrease and an asset? Right. So where are you gonna record decrease and an asset? Right. If there is decrease and asset, if you go back to the debit and credit rules I showed you, so decrease and an asset should be recorded on the credit or debit on the ledger account, so should be recorded on the credit side, decrease an asset. I hope you still remember the accounting rules. If you go back, this one, do you remember these, the one I showed you guys? These accounting rules. So goes down, assets goes down on the credit side and assets goes up on the debit side. So the question here asks you what? Where would you record a decrease in asset? So that will be on the credit side of the ledger account. So the answer is A. The answer is A. Okay. Trial balance is a list of. So what is trial balance? So the first thing, before you prepare trial balance, what we do, we identify the transactions. We record the transactions through ledger account, debit and credit. After we record them, we balance off the account. And after we balance off the account, we prepare the trial balance. We prepare what? A trial balance. So the trial balance is all the debit and credit balances in the account. All the debit and credit balances in the account. So the answer is D. The answer is D. The answer is D. So that you do the trial balance after you record the T account and after you balance off the account. And this is the final step which you prepare the trial balance. The one debit and the one is credit, and both should equal each other. Okay, C4. C4 is supermarket purchased food items for resale on a credit from supplier, which is the Goldman Limited, right? So now what happened? Supermarket bought something, bought goods, these goods for resale, of course, on a credit means they haven't paid the cash yet to the supplier, which is the Goldman Limited. So straight away, we're gonna look at the trade payable straight away. So which is a creditor, the Goldman Limited. So what is really the entries in the supermarket's account? So first of all, supermarket purchases. So we look at purchases. So the debit purchases, and purchases is always on the debit side. If you go back to check the rules, you can see purchases is always on the debit side. So we have A or C. And on the credit side must be what? Must be trade payable. Must be trade payable, which is the Goldman Limited. Why? Because the business hasn't paid yet money to the creditor. So they have to pay the money. So that's why liability goes up on the credit side. And that's why we have on the credit the trade payable, which is the Goldman Limited. So the answer is A. The answer is A. Okay. Let's have a look at C5 here. A supermarket buys a motor van on a credit from Park Motors Limited. Right. So what would happen here, guys? So now this supermarket buys a motor van. So do not consider these purchases. Why? Because these are not purchases. Motor van is classified as a fixed assets. Yeah, as a fixed assets, and you need to record it on its account. It's not purchases. Be careful. So they bought the motor van from on a credit. This means a trade payable should be there, the Park Motors Limited. So here we go. So motor van is an asset, and asset goes up on the debit side. So I imagine motor van would be the debit side, and the credit side will be the Park Motors Limited, isn't it? Will be the Park Motors Limited on the credit side. Why in the credit? Because it's payable, is a liability, is a payable, and liability goes up on the credit side, on the credit side. Right. C6. A supermarket pays a supplier, Goldman Limited, the amount owed in cash. Do you remember in the previous transactions that when this supermarket bought some purchases from Goldman Limited on account on a credit, and that's why they have a trade payable? Do you remember? But now what happened? This supermarket paid the supplier Goldman in the amount in cash. In this case, the cash goes down, is money out, credit. And the Goldman, the trade payable should be going down. Trade payable should be going down, liabilities should be going down. So that would be on the debit side. That would be what would be in the debit side. So that answer is A, isn't it? The answer is A. So the debit, trade payable go down on the debit side, and the trade payable is the same as Goldman Limited, isn't it? Why? Because we paid them the money, so liabilities goes down, and trade payables goes down the debit side. And how did we pay it? By cash, and that's why cash is money out, and money out is a credit. C7, a supermarket pays the wages of its staff by credit transfer from its bank. So that must be really straightforward, really. Wages as an expense. And if you go back to the debit and credit rules, you know that all wages must be recorded on the debit side. So wages should be debit all the time. And of course, how did we pay for wages? Through bank and transfer is money out. So bank is money out, and money out on the credit side. So the answer is A. The answer is A. The answer is A. Okie dokie. Right, let's have a look at D1 here. Which one of the following is true? Fixed assets are bought with the intention of resale, and that is wrong. And if you remember, what is the point of fixed assets? Is bought for the business use and not for resale. Fixed assets tend to change constantly in amount and composition, and that is correct. That is not correct actually, because fixed assets is not the fluctuate really. It depends on the market value, and we have to take away the depreciation from it, but that's wrong really. The fixed assets, or the term fixed assets, cannot be applied to items which can be moved. Not really. Can be. Yeah, why not? Can be. That's wrong. The fixed assets are normally used in the business on a long-term basis, and that is correct. So the answer is D. The answer is D. So the answer is D. So fixed assets are normally used in the business on a long-term basis. So that's more than 1 year. Okay. Let's have a look at D2. A piece of machinery held for continuing use in the business would usually be stated in the statement of financial position. Again, at which value? And now we talk about the after you take away the accumulated depreciation, if you remember. So it does need to reflect the fair value or the net book value. So of course, the answer is B. The answer is B. So that's when we calculate the net book value, the historical cost minus the accumulated depreciation, minus the accumulated depreciation. This is the net book value, which we need to be calculated. And based on this, we reflect and write it in the statement of financial position for the business. And accumulated depreciation equal depreciation for this year and also previous years. So the answer is B. D3. Drawings by sole trader. Drawing by a sole trader are what? An expense? No. Items for office decoration? No. Liability? No. An appropriation of profit? Yes. Okay. So now, when it comes to drawings, so the owner or the sale trader, so withdraw the profit, withdraw the profit itself, and that's a percentage profit itself as a drawings. Okay, but this is the answer is D. The answer is D. So this is drawing just only applies for a sole trader, doesn't apply for a public limited company. Yeah, just bear this in mind, or limited or private limited company. Okay. Okie dokie. Let's have a look at D4. D4. Okay, that's an interesting question. Okay. Right. A business has net assets at the beginning of 2019 of 101,700. It's fine. Profit earned by the business during 19 was 72,500. The owner withdrew goods for his own private use, which had cost to 500. And what were the net assets at the end of 2019? So that's a really simple question. And I think this question is way similar to the one we calculated, number 12, at the beginning. So, but let's have a look at this question and find out what's going on really. So, if we apply the formula, which is that net assets at the end of year, okay, equal net assets at the beginning of the year, okay, plus profit, and what else we have? Minus drawings. Here we go. That's it. And don't forget net assets. What do I mean by net assets? Net assets as equity. Net assets is the same as equity. If you remember, I explained this. Net assets equal equity. So equity at the end of the year equal equity at the beginning of the year plus profit minus drawings. Here we go. So here we go. Net assets. If you apply the formula equal, we have the net assets at the beginning of the year is 101, is it? Is it 101, 700, that's fine, plus profit, 72, 500, minus the drawings, which is 2,500. So here we go, let's calculate it. Where's the calculator? 101, 700 plus 72, 500 minus 2,500. Okay, and that gives you 171. 700. Here we go. So the answer would be B. The answer is B. The answer is B. D4B. Okay. 171, 700, and that's the net assets at the end of the financial year. So please treat net assets as equity, because net assets equal equity. As I mentioned, net assets equal total assets minus total liabilities. And you know total assets minus total liabilities equal equity anyway. So please bear this in mind. Okay. So the answer is here. Here we go. D5. For accounting purposes, an asset is essentially a resource held by the business. That's fine. Okay, we know that. Which has certain characteristics. We know that. Which of the following is not, look, is not a required characteristics of an asset? Is not. I mean, in accounting, if you realize an asset, there are some characteristics which you define an assets. So here, the question asks you which of the following is not required. Is not required, right? Is not required. So be careful. So the first one is an asset must have a probable future benefit exist. That's correct, 100% correct. So yes, this is a requirement of an asset. Must be future benefit exist for this an asset. That's the right one. It does require this. B, the business has an exclusive right to control the benefit. That's correct, actually. This is absolutely a requirement and characteristics of the assets that the business has an exclusive right to control this benefit. And the benefit must arise from some past transaction or event, and that is correct also. The characteristic needs some past event to really to arise the benefit from it. So that is a requirement. And D, it must have physical substance and be capable of being touched. Not really. That is not requirement. That is not requirement at all, guys. Is not requirement at all, guys. Why? Because the assets, it doesn't have to be physically touched. Yeah. Because we have assets, we have tangible assets which can be touched, such as equipment, trucks, computers, and we have intangible. Intangible means cannot be touched. And now we talk about copyrights, we talk about trademarks, and these patents, all these type of things, and that can be, of course, untouched. And that is number D5. It's DD. Is not a required characteristics of an assets. Okay. D6, a business changes from depreciating its vehicles at a 25% on a straight line basis to 10%. What will be the effect of this change on a profit? I mean, if the business change the methods or the depreciation charge, it was at 25%, and now it is now 10%. So what would be the effect on the profit? I mean, it is just very simple way to say, of course. Now, when it comes to this, of course, that profit will be increased. Yeah, why? Because if you decrease the depreciation charge, the depreciation will be less. And as a result, the expenses will be less. And if the expenses is less, that will make the profit is more. So the question is, or the answer is, of course, the increased profit. So B. D7, a business buys £1,000 of stock on a credit. So that means purchases, and it's on a credit. That means trade payable, because a trade payable is a credit side, isn't it? Trade payable, it's on the credit side, and purchases are made on a credit. This means the company hasn't paid yet the supplier yet. So yeah, so what would happen here, guys? So the creditors will go up and the stock will go up. So when I say stock go up, means purchases, isn't it? And the creditors will go up on the credit side. So that will be, the debit will be purchases, and a credit would be what? Trade payable or a creditor. Or creditors is the same, trade payables or creditors. D8, a firm bought a new vehicle for £10,000, so that is the cost. expected to be useful life for 5 years, and sold for 2,000. So that's a residual value after 5 years. So what is the annual amount of depreciation if the straight line method is used? I mean, that should be really straightforward, guys, to apply. So depreciation cost minus accumulated, no, cost minus residual value, if you remember, I hope you do, divided by useful life. Okay, so if you apply it, the cost is £10,000 minus £2,000 residual value divided by useful life, which is 5 years. So here we go, guys. So that's 8,000 divided by 5, that make £1,600. Okay. So that's that depreciation charge, and the answer is B. The answer is B. So £1,600 is the depreciation charge for the year. Okay, and that's this depreciation charge will be £1,600, and that will be applied for every single year for 5 years. For what? For 5 years. Okay. So that's all to do with the question number 4. And now let's move to a question number 5. And we have a few multiple choice questions from question number 5. And the first question is, which financial statement is used to show what firm owns, what the firm owns? I mean, of course, this is this financial, of course, it's statement of financial position is the balance sheet, is the statement which show what the business owns, She does show the total assets, total liabilities, and also the equity, So that's important to understand this, guys. So question number 5, number 1 is B. Financially, shareholders are rewarded by. Okay, now what do I mean by shareholders? Shareholders, so if you have some spare money, yeah, for example, if you have £1 million and you don't know what you're gonna do with it, maybe, hopefully, fingers crossed, always believe and dream. So if you have this amount of money and you want to buy shares, you need to invest in some companies. For example, you think that's a good company to invest in the future, maybe Tesla, you know, the electric cars. Or maybe you think another company you look at is Apple's, maybe. I don't know. You just choose whatever you want, yeah? So these companies, when you invest, if you invest money, this means you buy shares. You buy what? You buy shares. And if you buy shares, you have become a shareholder. You become what? A shareholder. So you are a shareholder of that business. So if you are a shareholder of that business, you are entitled to dividends at the end of each financial year. At the end of each financial year, you are entitled to dividends. Dividends is a percentage of the profit that company distribute to all shareholders based on the holding, based how many shares they have on the business. So yeah, so financially, shareholders are rewarded by, of course, dividends. So in terms of the tax, dividends are taxable. So if you have dividends, you also need to pay tax on it. I think the first £2,000 dividends are free every year, but I think after that you should pay tax here in the UK. Dividends, everything is taxed, guys. Everything. Okay, number 3. So number 3, what type of accounting which reports on the performance of a firm to essential external users. So when we talk about external users, that's the difference. External users, straight away, when you look at this and you see this, straight away, this is financial accounting. Financial accounting. If I changed this to internal, if I said instead of external, if I said internal, you would go with management accounting. You would go with what? With management accounting. So yeah, so external users is related to what? To financial accounting. Number 4, when does an accountant record a transaction? I mean, think about it. The accountant will record transaction when there is a monetary value, when it is materialized by a concrete document, means that there is a monetary value, guys, on it. There's a monetary value, and that's why basically when does an accounting record a transaction, okay? So it's not about to do with tax implication or manager's demand. It does need materialized, okay? Monetary value does have monetary value. It can be anything. It can anything as long as there is a monetary value. For example, if you go to buy something from the shop, this is transaction. If you take money from the ATM, this is transaction. If you buy something from Amazon, this is transaction. If you buy a drink, this is transaction. Everything has a value, monetary value. Number 5. Which of the following groups use financial accounting, right? As I mentioned, financial accounting is mainly concerned with the external users. So management, employees, shareholders, lenders, yeah, of course, they use. Of course, anybody is interested to find out the profit of the business, the revenue, the assets, the liabilities. Suppliers, customers, competitors, yes, of course they do. Of course, competitors, they are interested to find out what they do, how they're doing, their competitors, of course. Customers, of course, can be suppliers. Tax authorities, government, and general public, yes. So I'll answer all of above. So financial accounting is all above. Everybody's interested to find out about financial accounting. Which of the following describe a record of a transaction? Yeah, do you remember when we record the transaction in T account? This is called a journal. Yeah, it's called what? It's called a journal. Yeah, journal. Journal. Yeah, guys. Okay. And the last question here, we have number 7. Okay. A loan due for repayment in 20 months, so that's after 20 months we'll repay the loan, has been included as a current liability. What will be the effect when this is corrected? When this is corrected. Now, okay, now a loan due for repayment in 20 months time has been included as a current liability. But as you know, that should not include it as a current liability. That should be included as what? As a non-current liability, as a long-term liability. It's nothing to do with current liability because it's more than 12 months. What will be the effect when this is corrected? Okay. Increase in net assets, increase in net current assets, no effect on net current assets, and none of the above. Right. So the answer actually, the net current asset or the net current asset should be increased. So the answer is A. It's B, sorry. The answer is B. The answer is B. So there is increase in net current assets. Why there is increase in net current assets, guys? I'm telling you why. Okay. Let me show you an example so you can understand. Okay. Right. First of all, what is the net current assets? Net current assets equal total current assets minus total current liabilities. Look, So this is a net current assets. Okay. Total current assets minus total current liabilities. Okay, fine. So what happened here? Let's make up some numbers. Let's say current assets, let's say equal £20,000. I'm making up some numbers, yeah. Current liabilities equal £12,000. Including £1,000 loan. This is the one for 20 months, but this loan should be under not current liabilities, isn't it? Right, guys. So apply the formula. If you apply the formula, that's net current assets equal current assets, which is £20,000, minus the current liabilities, which is £12,000. That makes what? Makes £8,000. So the net current assets equal £8,000. That's fine. Okay. So now what happened really? So now, net current assets equal £8,000. That's fine. Now, under the current liabilities, the £12,000, we have included £1,000 loan, and this loan must not be here under current liabilities. We should remove it. Why? Because this must be under non-current liability, because it's more than 12 months, isn't it? So we need to remove it. In this case, let's remove the loan. So revised total current liabilities equal what? £11,000, yeah, correct? So now revised net current assets, how much would be? Would be 20,000 minus what? Minus 11,000, and that makes how much? Would be 9,000, isn't it? Would be 9,000. So what happened, guys? What happened before revise and after revise? What happened? Before revise it was 8,000, but after we remove the loan from the current liability, what happened with the net current assets, revised one? What happened? Goes up by 1,000. So the answer is B, increased net current asset. The net current asset increased when you remove the loan from the current liabilities. When you remove the loan from the current liabilities. I hope it's clear. It's tricky one, but it's really, I hope it's really clear, guys. So that's various questions on accounting, including different topics. Some really straightforward, some tricky questions. Debit and credit practice is all about practice. Make some notes. So you need to maybe make your own notes. You can go back and look at them. It's really important, and I found this strategy really good, to make your own notes and you go back and revise them in the way you understand, the way you read them, the way you prepare them. That's really important. But always is the key to practice as much as you can questions. This is accounting, and that's the way you get confidence. Okay, guys. Thank you for watching, and thank you very much. Take care. All the best, guys. Bye-bye.